What's going on, everyone? Charlie here. We have a couple of filings to talk about today, and still hopeful on the day, by the way, just to point that out. We have SR-PEARL-2021-38. It's a notice of filing and immediate effectiveness of a proposed rule change to amend the MIAX Pearl options fee schedule to adjust the options regulatory fee. So the purpose of this, currently the exchange assesses ORF, which is the options regulatory fee, in the amount of 0.0028 per contract side. The exchange proposes to reduce that amount from 0.0028 to 0.0018 per contract to help ensure that revenue collected from the ORF in combination with other regulatory fees and fines does not exceed the exchange's total regulatory costs. The exchange proposed change to the ORF should balance the exchange's regulatory revenue against anticipated regulatory costs. They initially filed this on July 30th and withdrew this filing on August 12th, and now they propose to implement the fee change effective August 12th. So basically, it will be effective tomorrow because it's on the Fed Register today. So basically, the collection of ORF, how it currently works, they assess the per contract ORF to each member. And the term member means an individual organization that is registered with the exchange pursuant to Chapter 2 of the rules. It can be as an electronic exchange member or market maker, for example, are considered members. So it assesses the per contract ORF to each member for all options transactions, including mini options, cleared or ultimately cleared by the member, which are cleared by the OCC, in the customer range. Now, the customer range, exchange participants must record the appropriate account origin code on all orders at the time of entry in an order. The exchange represents that it has surveillances in place to verify that members mark orders with the correct account origin code. So basically, if a member that was the ultimate clearing firm for the transaction, or a non-member that was the ultimate clearing firm where a member was the executing clearing firm for the transaction, is when ORF is collected on the OCC. As a practical matter, when a transaction that is subject to the ORF is not executed on the exchange lacks the information necessary to identify the order entering member for that transaction. There are a multitude of order entering market participants throughout the industry, and such participants can make changes to the market centers to which they connect, including dropping their connection to one market center and establishing themselves as participants on another. I think that has something to do with arbitrage. Now, for these reasons, it is not possible for the exchange to identify and thus assess fees such as ORF on order entering participants on away markets or off exchange on a given trading day. Clearing members, however, are distinguished from order entering participants because they remain identified to the exchange on information the exchange receives from the OCC, regardless of the identity of the order entering participant, their location, and market center on which they execute transactions. Therefore, the exchange believes it is more efficient for the operation of the exchange and for the marketplace as a whole to collect the ORF from clearing members. So they're adding clearing members as a category of participant that they will be collecting from when they previously did not. So the exchange monitors the amount of revenue collected from the ORF to ensure that, in combination with other regulatory fees and fines, that it does not exceed the regulatory costs. In determining whether an expense is considered a regulatory cost, the exchange reviews all costs and makes determinations if there is a nexus between the expense and a regulatory function. The exchange notes that fines collected by the exchange in connection with disciplinary matter offset the ORF. Now, the ORF is designed to recover a material portion of the cost to the exchange of the supervision and regulation of its members, including performing routine surveillance, investigations, examinations, financial monitoring, and policy rulemaking, interpretive, and enforcement activities. So what are they proposing exactly? Well, again, they're going to add the clearing members as a category. They're going to reduce the fee from 28 to 18.0018 per contract side, effective tomorrow. The proposed decrease is based on recent options volumes that we saw in 2020 and 2021. Due to increased retail volumes, that's why they're decreasing this fee, so that they do not exceed regulatory costs. They are also proposing it, basically. They particularly believe that decreasing the ORF when combined with all of the exchange's other regulatory fees and fines would allow the exchange to continue covering a material portion of its regulatory costs while lessening the potential for generating excess revenue that may otherwise occur using the current rate. And by the way, the ORF is not designed to cover the cost of option sales practice regulation. So in essence, the ORF designed to recover a material portion of the cost of supervising and regulating members' customer options business, including performing routine surveillance and investigations. They're basically covering those costs by charging a fee per contract side that they just reduced, and now they're going to include clearing members as part of the members that will have to be collected this ORF from. So that's basically it. Still Jack for today. I'll talk to y'all later. This should be in effect tomorrow.